If the stock market has ever given you anxiety before, and if you're being honest, you're probably raising your hand right now. That is something that happens to a lot of people, and today we're going to try to help that. The way that we're going to try to help that is try to educate you on how the stock market works, kind of what makes it tick, what you can maybe expect going forward on a regular basis so that you can mentally prepare yourself, and most importantly, what actions you're going to take in advance so you have a better chance of reaching the goals and everything else that you set forth to do based on these investments that are kind of a building block to help you get there. So to kind of start off, I grew up in a family that had a lot of different cousins. My mom had a number of different sisters, a lot of cousins that were older than me, and so I learned a lot from them. Now, some of the things that I learned from them were very good. Other things, maybe not so much. So one of the examples of a really great thing that I learned is if you're playing inside and your mom has a fancy clock and you happen to break the glass in the clock because you were doing something that maybe you were not supposed to be doing, a great way to hide that from your mom so you don't get into trouble is to take the glass out of the clock, throw it away, and now it just looks like the cleanest clock ever, and your mom's probably not going to figure that out. So 10 to 15 years later, mom finally figured out that her fancy clock didn't have glass in it, and by that time it was over and we didn't really get into trouble anymore. On the other hand, my cousins also taught me how to put saran wrap on a toilet seat, which is not a good plan, not good advice. My mom was not happy with that, and rightfully so. We got into plenty of trouble, a couple punishments for that one, and that's kind of how it goes. So just like with my cousins, sometimes you get good advice, sometimes you do not get good advice, and when it comes to the stock market, there's a lot of people saying a lot of different things, and so it's important to kind of focus on what am I expecting, what are my base level behavioral things that I expect to be able to employ when the stock market does what it does. So let's go through some of that today so you understand more of how the stock market works and how maybe mentally approaching it in a little bit of a different way can make the ups and downs a little bit more bearable if we understand kind of where they're coming from, what's driving them. So the stock market is what they call a leading indicator. It's not waiting to see what's going to happen. It's trying to predict in advance what's going to happen. So for example, let's say that Apple is expected, they think it's going to earn $110 billion in quarterly revenue. The stock market is going to buy up to that price for Apple so that the company is basically worth a $110 billion revenue a quarter type of a company. It's not going to wait for the actual quarterly report to come out. It's going to basically guess that that's expected to come out, and we're going to price that into the stock in advance. So now let's say Apple releases its quarterly report, and instead of earning $110 billion in revenue, they only earn $100 billion. We would expect then the stock to drop, right? Because it was already kind of baked into the pie, this $110 billion quarterly revenue company, which it turned out not to be this quarter. So then the stock price is going to come down. It's not like Apple lost money. It's not like they're going bankrupt or anything like that. But because they didn't meet the expectations, and the stock market, again, is basically guessing to say, this is what I think is going to happen, so I'm going to price that in advance, it's a different kind of a situation for how it reacts to it. Still a profitable company, still a great company, but at the same time, it wasn't where we were expecting it to be. On the flip side, if Apple comes out and they earn $120 billion in quarterly revenue, then it wasn't built in enough, and we would expect the stock price to jump up accordingly. So the stock market is this leading indicator. It's kind of trying to guess what's going to happen in advance. And so when we look at the times that the stock market can't really predict, it doesn't really know what's going to happen, that makes it scared. That means it doesn't really know what it wants to do or not, and that's when you see lots of volatility. So more uncertainty tends to be more volatility, right? And so when you look back over the last 10 plus years, 20 plus years, the times that there were the greatest uncertainty is the time that we saw the most volatility in the stock market. So 2008 with the financial crisis, 2020 with COVID, 2022 with interest rates going up, so far in early 2025 with tariffs. These are all times of uncertainty. And when the market doesn't know what's going to happen, it reacts very volatile, and usually it reacts very negative in a volatile way until it has a better idea of what's going to happen. So 2008 with the financial crisis, who's getting bailed out? Who's not getting bailed out? Well, once we had more certainty on what that landscape looked like, what happened, volatility started to go down, stock market started to come back up. 2020 with COVID. Hey, are we going to have a vaccine? How far is this going to spread? What's going to happen with that? Once some of those questions start getting answered, once we feel like there's more certainty in the air for what's going to be going next, 1, 2, 3, now you start seeing volatility go down. Now you see the stock market start coming back up. Same thing 2022 with interest rates. Right now, beginning 2025, we're in the midst of that. So that's how the stock market is almost certainly going to act when there is uncertainty. And now that we know it's a leading indicator, we can kind of understand why. So if we're saying, hey, how often does this kind of thing happen? I mean, these are all really unique events, right? It may be surprising to learn that every 1 to 1.5 years, the stock market has a 10% or more drop. And so it happens quite frequently. And because it happens quite frequently, we need to mentally prepare ourselves in advance. So you might say, hey, these were all kind of separately unique things, or they may not happen again. And you're right, they may not happen again, but there will probably almost certainly be more things that have never happened again, or that have never happened in a really long time, that are going to drive this. Because if something has already happened and then it happens again, there isn't great uncertainty. We've already seen this play before. We already know kind of the steps of what most likely will happen. But the uncertainty when it comes up, whether it be new political parties or whatever it might be, there's going to be uncertainty that happens again in the future. And when it does happen, we should probably expect to see more volatility in the stock market. So from our perspective, what can we do, right? Because we can't control tariffs, we can't control COVID, we can't control financial crisis. These are things that are not in the everyday person's control, right? What we can control are our actions, our reactions to this by preparing in advance. If we know that, hey, this is going to most likely happen every 1 to 1.5 years on average, that there's a 10% drop or more in the market, we can mentally prepare ourselves for what we may want to do and may not want to do. So what we don't probably want to do is pull all of our money out of the market when it's down. So COVID was a great example of that. Around the first couple, at the end of the first quarter or so, down 20, 25%, whatever it might be. And by the end of the year, it's up double digits. So if you pulled all your money out, put it on the sideline, said, I'm going to wait until there's more certainty in the air. Once there's more certainty in the air, the market already went up again. Because again, it's a leading indicator. It's trying to kind of guess that in advance. So if you wait until the market seems like it looks better, quote unquote, now you probably already missed the boat, train's already left the station, and you pulled your money out when it was low, and you didn't have it there to be able to jump back up when the market kind of turned around. So in another sense, it's kind of be like, having solar panels and bringing them in because there's a storm, and then trying to rush back outside and put them outside when the sun comes back out. It's really, really hard to time that correctly to do it. So a better approach, if you have your money invested and it's invested for the long term, because if you need your money in the short term, it probably shouldn't be invested at all, because you never know when these kind of storms are going to come. So in the short term, you need the money in a couple months, 6 months, 8 months, 12 months, you should probably have it on the side in cash so it's protected. But if this is money that you need to hit your retirement goals or any other goals that you might have, it needs to probably be invested for you to have a chance to do that. And so you need to mentally prepare yourself. Hey, what am I going to do when the next one happens in a year or a year and a half or 2 years or whatever it may be? Am I going to try to pull my money out, or am I going to leave it there and have it invested so there's an opportunity for it to come back up like historically it's been able to do? So we need to realize that every new thing that's going to happen is going to be great uncertainty. It's not going to happen a million times before. There's going to be new events, and that uncertainty is going to drive the volatility, and it's up to us to choose the right course of action to make sure that we're giving ourselves a chance to be in there. We don't want to be jumping off the roller coaster halfway through the ride. We want to make sure that we're giving ourselves an opportunity. I get so often, hey, I don't want to invest right now because the market seems to be volatile. The best time to invest is when the market is low. So if you have money sitting on the sideline and the market is low, it's probably a great time to invest that money if you're not going to need the money for a number of years down the road. It's funny because we all love buying shoes on sale. We love buying groceries on sale. We love buying vacations on sale. We love buying airfare on sale. We love buying all this stuff on sale. The one thing we seem to have trouble with buying on sale are stocks. So if the stock market is down, most likely that means that it's on sale, and it could probably very well be a good time to invest. So one, realize stock market is a leading indicator. It's going to try to guess what's going to happen in advance. Two, when great uncertainty happens, what should we expect? We should expect a lot of volatility. 3, how often should we expect this uncertainty and volatility to happen? Probably once every 1 to 1.5 years on average is what we should expect. 4, how should we prepare for this? Because the causes are going to be outside of our control. We prepare by mentally setting ourselves up in advance. If I'm going to be investing for the next 30 years, I should expect 15, 10% drops or more in the market during that next 30-year period on average, if history is any indicator of that, and make sure we're controlling, hey, what am I going to do when it happens? Am I going to freak out and pull out my money, or am I going to give it a chance to recover and get back on track for those goals that I might have? So hopefully today gave you a little bit more background how the stock market works, what drives it crazy, and how you can better prepare yourself for the next time that it does happen.